Saudi Arabia, the world's largest oil exporter, has announced a surprising move to cut its oil production by 1 million barrels per day, BPD, in July. This is on top of the existing cuts agreed by the OPEC Plus alliance of major oil-producing countries, which have been extended until the end of. But why did Saudi Arabia decide to make this extra cut, and how will it affect the global economy? The main reason behind Saudi Arabia's decision is to support the oil prices, which have been under pressure from weak demand and rising supply. The global economy is still recovering from the impact of the COVID-19 pandemic, which reduced the need for fuel and transportation. At the same time, some oil-producing countries, such as Iran and Libya, have increased their output after resolving some of their political and security issues. This has created a supply glut in the oil market, which has pushed down the prices. By cutting its output by 1 million BPD in July, Saudi Arabia hopes to reduce the excess supply and balance the market. This would also benefit other OPEC Plus members, who rely on oil revenues to fund their budgets and social programs. Saudi Arabia's energy minister said that the cut was a Saudi lollipop to stabilize the market and add suspense. However, not all OPEC Plus members are making the same sacrifice. Some countries, such as Russia, Nigeria, and Angola, have been allowed to keep their output levels unchanged or even increase them slightly. This is because their actual production has been lower than their targets due to technical or operational issues. On the other hand, the United Arab Emirates, which has invested heavily in expanding its production capacity, has been granted a higher output quota, and the impact of Saudi Arabia's oil cut on the global economy will depend on several factors, such as the demand recovery, the supply response from other producers, and the geopolitical risks. In general, lower oil supply means higher oil prices, which can have both positive and negative effects on different sectors and regions. Higher oil prices can boost the income and confidence of oil exporting countries, such as Saudi Arabia and its allies. This can stimulate their domestic spending and investment, which can have spillover effects on other economies through trade and financial links. Higher oil prices can also encourage more investment in alternative energy sources, such as renewables and nuclear power, which can reduce greenhouse gas emissions and improve energy security. However, higher oil prices can also hurt the consumers and businesses in oil-importing countries, such as China, India, and most of Europe. This can increase their energy costs and inflation, which can reduce their purchasing power and profitability. Higher oil prices can also dampen the economic recovery from the pandemic, especially if they are accompanied by supply disruptions or geopolitical tensions. Higher oil prices can also worsen the trade balance and fiscal position of oil-importing countries, which can increase their debt burden and vulnerability. Therefore, Saudi Arabia's oil cut is a double-edged sword for the global economy. It can help stabilize the oil market and support the income of oil producers, but it can also raise the energy costs and inflation of oil consumers and slow down their growth. The net effect will depend on how long and how deep Saudi Arabia's cut will be and how other factors will evolve in the coming months. How the oil cut affects the economic growth, inflation, and consumer spending in different regions of the world. Saudi Arabia, the world's largest oil exporter and a key member of OPEC+, has announced that it will cut its oil production by 1 million barrels per day in July, on top of the 2 million barrels per day it has already reduced since October last year. This decision is aimed at curbing market volatility and balancing supply and demand, as well as supporting the sagging cost of crude oil, which has been affected by weak global demand and rising supply from other producers. But what does this mean for the global economy, and how will it affect different regions of the world? Let's take a look at some of the possible impacts of Saudi Arabia's oil cut on economic growth, inflation, and consumer spending. First, let's consider the impact on economic growth. Oil is a vital input for many industries and sectors, such as transportation, manufacturing, agriculture, and electricity generation. A lower supply of oil means higher oil prices, which can increase the cost of production and reduce the profitability of businesses. This can have a negative effect on economic growth, especially for oil importing countries that rely heavily on oil for their energy needs. However, higher oil prices can also stimulate economic growth in some cases, especially for oil exporting countries that benefit from increased revenues and foreign exchange earnings. This can boost their public spending, investment, and consumption, as well as create more jobs and income opportunities. Moreover, higher oil prices can also encourage more innovation and efficiency in the use of alternative energy sources, such as renewable energy, which can reduce dependence on fossil fuels and enhance environmental sustainability. Second, let's look at the impact on inflation. Inflation is the general increase in the prices of goods and services over time. A lower supply of oil means higher oil prices, which can increase the cost of living for consumers and businesses. This can lead to higher inflation, especially for oil importing countries that have to pay more for their oil imports. Higher inflation can erode the purchasing power of consumers and reduce their real income and savings. It can also increase the cost of borrowing and discourage investment and spending. However, higher oil prices can also have a moderating effect on inflation in some cases, especially for oil exporting countries that have more fiscal space and monetary policy flexibility to counteract the inflationary pressures. For example, they can use their oil revenues to subsidize essential goods and services for their citizens or to lower taxes and interest rates to stimulate economic activity. They can also use their foreign exchange reserves to stabilize their exchange rates and prevent currency depreciation. Third, let's examine the impact on consumer spending. Consumer spending is the amount of money that consumers spend on goods and services. A lower supply of oil means higher oil prices, which can reduce consumer spending, especially for oil importing countries that have to spend more on their oil bills. Higher oil prices can also reduce consumer confidence and expectations about future income and economic conditions. This can lead to lower consumption of discretionary goods and services, such as travel, entertainment, and leisure. However, higher oil prices can also increase consumer spending in some cases, especially for oil exporting countries that have more disposable income and wealth from their oil exports. Higher oil prices can also increase consumer confidence and expectations about future income and economic conditions. This can lead to higher consumption of discretionary goods and services, such as travel, entertainment, and leisure. In conclusion, Saudi Arabia's oil cut can have different effects on economic growth, inflation, and consumer spending in different regions of the world depending on their level of dependence on oil imports or exports. Generally speaking, oil importing countries are likely to face more challenges than benefits from higher oil prices, while oil exporting countries are likely to enjoy more benefits than challenges from higher oil prices.